Introducing TiE Singapore Huddle Sessions.
Hi everyone, my name is Sidhi Dhir and I serve as the Executive Director for TiE Singapore. Thank you for joining us in our first of many huddles at TiE. In the face of the current COVID-19 situation, we started this initiative to assess the startups, combat various issues they might be facing or would face in the near future. These sessions would bring in investor and founder perspectives on various subjects and matters affecting the startup ecosystem. The huddles would be on every Wednesday at 5 p.m. So stay tuned and keep tuning in every Wednesday at 5. Tonight's huddle is on handling day-to-day challenges. I'm pleased to introduce today's moderator, Hari Krishnan. Hari is currently the CEO and Managing Director of PropertyGuru Group, Southeast Asia's leading property and technology company. He's a seasoned general manager and board director and a green guru, an ardent advocate of sustainable urban living solutions. Prior to PropertyGuru, Hari served as the Vice President and Managing Director APAC and Japan of LinkedIn, having joined the company as the very first hire of Asia Pacific region. Before I hand over it to Hari to introduce the speakers and kick off the session, I have a few housekeeping items to cover. First, today's webinar recording would be shared with all post this session. For questions, please use the Q&A button, either located on the top or bottom bar of your screen. And lastly, we would love to hear the problems you are facing in your business currently. So please share with us on the email provided in the chat box. Hari, over to you.
Thanks, Sidhi. Good evening, everyone. Welcome to this TiE Huddle. In what is fairly typical to these days of needing to be dynamic and flexible and rolling with the changes, this panel is no different. We've had a couple of changes. A few of us have been drafted in, but I think we are very lucky to have three distinguished panelists who get a chance to express their opinions on this very pertinent topic. We shall try and keep it brief and punchy, as I like to call it. That is to say, we shall try and not go for extended answers, which can limit conversation. As Sidhi mentioned, a couple of housekeeping elements. This is Zoom webinar mode, so only our panelists will have the joy of speaking, but all participants are welcome and requested to submit their questions via the Q&A button. Given our tight time limits, we shall endeavor to have a hard stop at 5:45 Singapore time. We may not be able to get to every every question, but let's see how it goes. We'll try and answer as many as possible, either live or within the Q&A. So let me spend a minute or so introducing our panelists. Sirucek is the CEO of Docdoc. It is a Singapore-based startup which labels itself a patient empowerment company, connecting patients with the best healthcare options and providers. I would assume this situation should help their product adoption, but let's see what he has to say about that. Thank you for joining us, Cole.
Thank you.
David Gowdey is the managing partner for Jungle Ventures, a seasoned investor in Southeast Asia and across Asia Pacific region. He was with TPG Capital prior to joining Jungle. And in a previous life, our paths overlapped when he headed up Corp Dev for Yahoo in the region. Welcome, Dave.
Thanks.
And finally, Ashish Wadhwani is a managing partner for IvyCap Ventures and is a board member of TiE Singapore chapter. He's a seasoned investor of over 25 years, and he's got a unique angle. He leverages global alumni ecosystems to identify and invest in potential market leaders. Welcome, Ashish.
Hi, thank you for having me.
Wonderful. So we have also three very different personalities at this Zoom virtual table today, and I shall try and get the best out of this group. Let's get started. So I'm going to just put one question to each of you, and you can sort of get us started that way. The first question goes to David. What's the advice that you are giving to portfolio company CEOs as the first steps they need to take in this unprecedented crisis that we're all facing?
Sure. So, I think the best way to answer that is, I think most investors would largely think about two groups. The first group are those founders that have greater than 12 or 15 months of cash runway. And then the other group is those that have less than 12 months of cash runway. And obviously, I think for those that are well capitalized to kind of play the markets out, I think it's an opportunistic time to look at the business model, to maybe test or have some experiments with adjacencies, to see whether or not you can drive more efficiency into the business. Typically for those founders, unless there's some sort of catalyst, unless there's a moment or a reason to look at the business, most of them are growing so quickly that they never really take the time to step back and think about the cost structure or what they would change if they really had to. And so I think this is a good moment in time to say, do I need that many people in customer service, or can sales be more efficient? Or what can I be doing differently? Is there an M&A or is there a consolidation opportunity, which maybe makes it more achievable for me given kind of where some other peers may be trading in the market? And so I think that's probably some of the things we would talk about to those founders. To the group that has less than 12 months of capital, then I think it's a much harder to tougher time for them. Trying to extend out from 6 months to 12 months is much harder than going from 12 months to 18 months. And so for them, I think it's really about going back to what is the core business, and cutting back, hopefully cutting back only once, but cutting back as much as you need to in order to keep the business going. I think the number one rule of business is to stay in business. And so, I think one is cutting costs where you can. I think the other one is that there's a lot of opportunities in the market today, particularly if you're based in Singapore, where there are government-sponsored programs where you can look at bringing on some either venture debt or some bank financing at very attractive rates that the government's made available. So seeing which programs they may be accessible to, but ideally trying to get at least 12 or ideally 15 months of runway into the business to try and ride this out. I think it's going to be difficult to raise capital in the next 12 months. So I think ideally trying to talk to most of our founders about getting about 15 or more months of runway.
Got it. Thank you, Dave. Very useful. And we might, I think that's already going to get a lot of people's thinking about their own businesses. The next question goes to the entrepreneur on the panel. So Cole, Dave brought this up, but this does give an opportunity to all business leaders and entrepreneurs to sort of step back and look at their businesses. How are you thinking about your organization and team? And I guess how and what are you communicating to them at this point?
I maybe let me take it. So there's a good question. Let me take it slightly differently.
Oh.
So we're all on lockdown, right? Everybody here is on lockdown. And in prison, they talk about either you do the time or the time does you. And I think that's a really important concept. So we're all on lockdown. My mom lives in Idaho in the United States. She's on lockdown. Some of my best friends are in New York. They're on lockdown. I've got good friends in India. They're on lockdown. About the only place in the world that's not on lockdown is in China. And so I think what we do with this time and where we go with our heads as leaders is going to be incredibly important. So the first thing I would tell anybody who's the leader of an entrepreneurial team, I don't care if you have 15 months in the bank or not, there's a lot of rough road in front of you. And that rough road can be channel partners, deals you thought were done aren't done, things that you thought were going to work will no longer work. There'll be a lot of rough road ahead of you. So get your lives really organized and regimented is the first thing I would recommend. We're on lockdown for a month, at least in Singapore. So, how are you going to use that time in a productive way? And I think that's really important because, so for me, it's about getting fit. It's about, or staying fit. It's about making sure I've got a couple of good books to read that I think are totally outside of my work, that are kind of a mental relaxation. So I'm reading a lot of Seneca right now, but you read whatever you want. That's what I'm doing. I'm spending a lot of time loving my family. And that's people that are close to me and people that are further away virtually. But I'm actually making a real effort to reach out and let them know how much I love them. And the reason I'm doing that is because I want my chi real clear when I go to make hard business decisions. When I get on a call with potential partners and they're all really afraid about what's happening in the world and they thought they were going to be doing X, Y, and Z in the next 12 months and that's changed, I have to be able to deal with that static in a productive way. And so I agree with David 100% about getting at least 12 months of runway in front of you. But what I would highlight as a founder and an entrepreneur, the value in your company is 90% between the eyes of the founder. It's their vision. and their ability to articulate that vision in the market for a very long time in the business. And so if you get wrapped up in the herd mentality of fear, you will not be able to make good things happen. If your chi is clouded, you will not be able to manage your team well. So as founders and leaders, you got to get clear. And you can't get clear if the time is doing you and you're not doing the time.
Got it.
And
And
you guys hear me?
that was one hell of a cryptic answer. Thank you for that. The getting your
How is it
cheek-
cryptic? No, I mean, if you're spending all day long watching MSNBC and watching your stock market, watching the value of your portfolio fall in your personal stocks, and you're talking, and every time you turn around, you're like, oh my God, this happened and that happened, and you're full of fear, and and then you pass that on to your team, then you're not making anything happen. You're not a leader. So you got to get your chi clear. Like it's very, very important. I don't know how to be clear. I'm sorry if that was cryptic. I don't know how to be clearer than I was.
No, I think at least for me that cleared it up. I think you're just saying make sure you're calm in the eye of the storm. Make sure you're clear when you're able to communicate those tough decisions to your team. And I think that's perhaps the best thing a leader could do in this time.
And you can't do that if your principles aren't clear.
That's fair.
Right?
Yep, agreed. Thanks, Cole. And I guess the next question goes to Ashish. Cole's obviously a passionate founder, and he's given us a lens of how to look at this. As you look at your portfolio companies, I think one thing that occurred to me was as this pandemic has played out, the reality is that certain markets, China and then to some degree Hong Kong and Singapore, sort of at the front end of this COVID breakout, and CEOs in other countries had the opportunity to observe what is happening here. And here, obviously, we're taking purely a business angle on it, not the personal consequences. But you do have this lagging effect where some countries started discovering COVID on their shores much later. When you look at your portfolio, which is obviously distributed across Asia, what is the advice you're giving companies based on the learnings you've seen in some of these early stage markets? But when they're looking out for those next 12 months that both Dave and Cole talked about, what has been your advice for the next 12 months?
Yeah, I mean, thanks, Hari. Let me start off with an analogy to this. If you're standing on the beach and your tsunami is about to hit you, whether you're watching it from a distance or of 2 feet, or whether it's 2 kilometers, it really doesn't matter. It'll come and hit you very hard. So that's broadly what we are watching. But coming back to how we are looking at it and how we are working with our portfolio to look at it, there are broadly 3 shocks to the system. One is really the health shock, and there are all kinds of assumptions around whether the virus will hit in 1 wave or 2 waves, or whether it will peak now or 3 months from now. That's one set of assumptions which drive business outcomes. Second is your demand shock, and depending on the level of lockdown and depending on the nature of industry that you are in, you are seeing anywhere from, I would say, plus 15-20% growth for those who are winners, to a complete shutdown for retail businesses. So there's literally nothing to do for them. The third uncertainty is around the funding and the private markets and how they will open up and how funding will open up. So around all these 3 axes, there are all kinds of assumptions to be made. And ultimately, you have to work with scenarios. We are finding all our portfolio sort of companies working with scenarios. So in this situation, I would say, literally there are 3 broad categories of companies. One, who are gaining because, let's say, people are buying essentials online. Let's say the social media companies, maybe gaming companies. We have a pharma platform which is gaining. We have a food delivery platform which is gaining. So these are sort of the winners because of the situation. There's the other end, which I call they need to go into a hibernation mode, which is something like maybe online jewelry or something like automotive or travel, for instance, right? Online travel. So these are more in the hibernation zone. And the middle category is basically you're, diving into a sort of frozen lake, taking a cold dip. Depending on the nature of the business, it depends how long that dip is and how you come out on the other end. But three broad factors that are important. I think one David mentioned is around the cash runway. We are advising all our companies to build 12 to 15 months of cash runway. The second is adaptability. The world is changing as we speak. As a consumer, as a business, as a buyer, as an investor, you have to adapt very, very fast. And linked to that is nimbleness, right? We are finding that entrepreneurs are being entrepreneurs, the ones who are finding creative ways of engaging their customers or finding alternate ways of alternate revenues, or being nimble around talking to their teams on figuring out how to cut costs and what is to be done to build that 12-month runway. Those are the people who seem to be a little bit ahead of the curve.
Got it. That's a good start. And I think one thing which I really liked that you said, Ashish, the next question is going to Cole, but the fact that different verticals or different industries need to operate differently in these scenarios. But Cole, you operate in a particular environment, a particular industry. Obviously, Docdoc is in health tech, and in a working from home, as I like to call it, a WFH world. Are you seeing any changes in behavior from consumers in using your product specifically or your sector? And in your mind, what remains a blocker to that adoption, given we've had such a massive shock to the system?
So on the capital is the negative side. I agree with David that the cost of capital has gone up meaningfully. So that's the difficult side. I think it'll be less severe for health tech because I think that what we're seeing now, one of the biggest problems in the health technology space has been around mobilizing the medical community, mobilizing the insurance community, mobilizing governments. And these groups tend to mobilize very slowly unless there's some kind of an external shock. This was kind of the shock that we needed. Like this will change the face of insurance tech globally. The insurers now will finally say, hey, we now realize why we just have to move. It wasn't just margin compression. It wasn't just competitive intensity. Our customers need this. You'll start seeing governments make a big move. So ultimately, this is going to be very positive for Docdoc. And it'll be positive in two ways. There'll be we're actually hiring right now. So there'll be I think there's going to be a lot of interesting talent in the market. And it'll be positive because I think, I'm already seeing it. I'm seeing people that we thought that were on our C list. Like we channel all of our potential insurance partners are A, B, and C, right? We had a couple C's come back this week who we weren't even talking to, weren't even putting any effort into. Hey, pilot's been approved. When can we start? We understand. When can we sign an MOU? I can't tell you what a move that is in psychology. Because it used to be us chasing so unbelievably hard to get an insurer to do anything. To have them come back like that, I think bodes very well for the sector as a whole. On the other hand, there's a lot of fear. And a lot of deals that I thought were much closer to being really monetizable in massive ways. Those I don't know what will happen with those. So this is that thing. You're going to have to manage the fear of your channel partners. You're going to get some pleasant surprises if you're in the right sectors. But it's really important that you stay clear because a lot of what's going to be coming at you is not clear. It's going to be very, we have to do this immediately right now, COVID fear. Maybe you can't deliver on that partnership. It's going to be, hey, the totally done partnerships that were ready to go, ready to roll, ready to scale. Hey, we need to pull back for 24 months because of COVID. So there's going to be overreactions everywhere. As a whole, it's positive. We're now being proven right. As an entrepreneur, you have to get in front of the curve. If everyone's talking about what you're doing when you're doing it, it's too late. So we started in doing health tech before it was cool or fashionable. And that's given us the assets that we needed to be here for a moment like now. And I think that's ultimately what history will say. But there's going to be a lot of fear on both sides. Some things I'm sure are done are going to come undone. And some things that I thought had no chance are going to get done in a way that surprises me. That's my read about being ambidextrous and being emotionally clear and being able to continue to paint that vision to the world, because that's the entrepreneur's single greatest talent, the ability to paint a clear and compelling vision to the world.
Got it. No, thank you, Cole. And good luck. I really hope the good things are better than the challenges. Ashish, a question for you. I think obviously cash flow management is the name of the game in 2020. I think every leader, every investor, every senior employee really is thinking about it right now. Any tips for entrepreneurs who have, till date, they've had their hands full running a growth business, they've been bullish. Entrepreneurs are fundamentally optimistic people and they're building for this future. Suddenly there's massive shock coming into 2020. They need to start tracking cash, particularly for the younger startups. That's not something that you take for granted if you're in that growth mode and looking at the sky. Any quick actions they can take when it comes to cash flow management?
Oh yeah, I think fortunately or unfortunately, this is my fourth crisis, starting with the Asian crisis. So there are plenty of scars and lessons to learn. But I think there are 4 or 5 areas. I think one is obviously on the customer and market side, lot of focus in terms of who your customer is, who you're going to serve, who's going to be able to pay you, right, over the next 3 to 6 to 9 months. Who's got the budgets? Similarly, a lot of focus around what exactly do you want to sell to them? Because sometimes entrepreneurs are also experimenting, which is fine if you're in the bucket where industries are winning, where you can experiment. But I'm assuming this is more relevant for those who are taking a big cold dip and need to manage their cash flows, right? The second important thing is your cost structure. I like to call it as variabilizing your entire cost structure. Think of how you can variabilizing every cost of yours. So if it's rent, can you go back and renegotiate rent? Can you work out an arrangement with your, whoever your warehouse guy is, that I could pay you on the number of linked to sales, right? It's tough, but no harm asking, right? Similarly, variabilizing even your salary structures. You can go back and talk to your employees about how you can have a stepwise comeback in case you're doing cuts. How you can have a stepwise comeback to your salary levels. You obviously have to cut deep for most of companies whose demand has been hit hard. There's no other choice. The other thing is looking at working capital. You have receivables. Now, I came across a very interesting incident, and one of our companies is trying it. They sell into dental clinics. And what they're doing to their customers is saying, here is a dental bond for you. And against this bond, you'll get a discount on your future purchases for the next 9 months. And there's a similar example apparently from a restaurant in New York, which is selling food bonds or restaurant bonds, right? Very creative ways of getting subscription revenues or deposits from your customers. There's another very important principle around cash flow management, which is that cash flow is more important than margin. So technically, and this is my earliest lesson from the Asian crisis days, technically I can sell on zero margin as long as my customer is giving me cash and I have a credit with my suppliers for 2 months. You're effectively financing your business. Now, obviously, you can't do that for 100% of your sale, but it still can give you a little bit of runway in the difficult months. I think two more important things here are, I would say, move away from P&Ls. Go to cash flow statement, the good old way where entrepreneurs, used to run their business. Cash flow, not accrual accounting, just cash flows, right? And the last would be to be creative in terms of raising financing, because I was with one of our portfolio companies, and they have a substantial business in the US. I think the scheme coming from the US government to finance some of their companies is very attractive. Similarly, I'm sure there's something around in Singapore where you can get sort of creative with your financing. So you've literally got to go through everything that drives cash into the business and makes you leaner, fitter, and meaner during this time, to go back to the original goal of 12 to 15 months cash runway.
Got it. Very, very interesting. David, I had sort of lined up this question in advance, but what's interesting is a lot of the live commentators are asking the same question. And,
I saw that.
We're hearing a lot about, VCs either pulling term sheets from new explorations, or there are changes happening with deals that are already in play. What are you seeing within the VC ecosystem, and what can you advise our entrepreneurs?
Sure. So, I haven't actually, or at least in none of our companies that from my vantage point, have I seen other VCs pulling term sheets or, not following through with deals that they were working on in January or February. In fact, we're closing a new investment this week, but it's one that we've been working on for a while now. But I think the thing to probably highlight is that, 90% of our time at the moment is being spent on the existing portfolio. So, we're working with founders to try and help them through this situation, whatever that might be. And I think the other thing too is that, founders come in vintages. And so if you think about a fund as a vintage, a very early fund, you'll always hold reserves, you'll hold capital back where you could invest, downstream in companies as they continue to scale and grow. And the older those funds are, the lower those reserves become. In some funds, if they're old, it may be fully extinguished. And so hopefully what you've done, over the years is you've built up a very strong cap table. And so you've got other people sitting around the business that you can work with to make sure that there's capital flowing into those companies. But most of our time is probably spent on the more recent investments. And so I think you'll see a lot of VCs spending more time with their existing portfolio, probably out of the current fund that they're investing out of. And that may mean, for this cohort of companies, that maybe there's fewer investments in this fund because these companies may actually take on a little bit more capital than what they're anticipating, which means the number of new deals go down. And so I saw that there was a question about, don't VCs take a long-term view? And I think the answer is absolutely yes. We all tend to take, 5 to 8 year view. But we also need to protect the equity that we've already invested. So I think you'll see VC spending a lot more time with founders, making sure that they've got the oxygen that they need to breathe. And they're probably not as focused on new deals. I think the new deals probably come back in the next couple of months. I think part of it depends on how the market corrects. But I think this year, I think if you can go flat, if you can show zero growth this year, I think that's a win. And so I think if I put myself in my chair in 2021 and kind of look at companies and try and think about 2020, I think most founders should be thinking about this year as a write-off, and that you should be thinking about, can I achieve the same level that I was at last year? Every business is different. Like Ashish was saying, I think SaaS businesses are a little bit different. There's some businesses which are kind of cyclical that are probably growing a lot more now than what they would have been. But I think generally, most founders should think about, how do I just maintain where I was last year or drive more efficiency into my unit economics?
Hari, if I may step into that, I think just to set the context, VCs don't act in isolation, right? They are dependent on their LPs for capital. And they're dependent on later stage investors, as well as public markets and large M&A buyers to sort of get clues on what will drive valuations and deals. Therefore, there will be a period of uncertainty. I think my hope is that given the amount of liquidity that is being pumped into the system, that has to move away from treasury bills or safe havens, which they are in now, into more riskier assets. Now, depending on how fast that happens, obviously there's a huge amount of liquidity out there, which is being pumped in. So that capital will come out into riskier assets. Now, once there is a little bit more certainty around that, I think you'll start seeing VC deals and markets, come back. But I think I also want to cover one important point, because a lot of what we have been saying is fairly gloomy. Don't forget that the world is changing. Consumers are changing. Businesses are changing. Habits of employees are changing. Therefore, there's a lot of opportunity. You need to reposition your products. You might come up with a SaaS. You may have a great SaaS product, which might work even better in the new environment as compared to earlier. A lot more offline customers might go online. I mean, certainly we started seeing that in SARS. It was the offline retail which was hit, right? And online started a bit after that. Similarly, here you might see a step function in terms of online growth. Similarly, productivity tools, so there are a lot of changes happening in the world, and entrepreneurs and innovators need to seize the moment to be able to benefit from that.
So, sorry, please go ahead.
Sorry, it's actually just advancing the question, and then just sort of taking one of the questions that has come from the Q&A. I think it's good advice. People need to be optimistic. That's what makes you an entrepreneur. But there are also some brass tacks that need to be handled. And I think one of the questions that's come through in Q&A is, in case you need to cut costs by reducing manpower, that always sticky point. How would you recommend proceeding with it? Who to keep, who to let go? Any process or method to decide? And Cole, you and I chatted a little bit about this. And as an entrepreneur, you're having to, you may or may not do it for your company. I'll let you respond. But I think in general, entrepreneurs need to be ready for that as a possible eventuality.
Sure. Just two thoughts on this. So to the previous comment that was made about behaviors changing, we're in a sea change now for InsurTech. So for a long time, a lot of fintech, a lot of InsurTech, a lot of health tech has been building, but the buyers hadn't been buying. They'd been flirting with buying, and they'd be in different stages of flirting. I think that's over, and you're going to see big marriages happen, and this will be because of that. So that's really positive. And I would really encourage all the entrepreneurs to take a deep breath and say, what does this mean to the market? Because this has changed the market. The market will be different now going forward when this is all over. Patterns, behaviors, things will have changed. Maybe ever so slightly, but they will be different. I know in my industry, it's a tectonic change. I can already see it. But in others, it'll even be ever so subtle. So pay attention, because your business model might have been really interesting 6 months ago. It might be less so now. And I don't just mean now and then through the blip. I mean now, like going forward. So keep a real eye on that. I think it's very sage advice that was brought up, and I just want to make sure that's called out very clearly. So how do you get rid of people in your company and scale down? This is always really hard. And unless you're a monster, right? Like hopefully your parents raised you to have a lot of empathy and to kind of try to hear the world, and there's a variety of things there, right? But unless you're a sociopath, getting rid of loyal people that are doing their best for you is an incredibly challenging, gut-wrenching thing to do. The way you do it quickly, you do it in one cut, and you cut too far. That's the best way to, if you're going to have to do it, do it. And what you do is you look at everybody in the company and you say, who is an A player? They may not be an A player today, but they are an A player in the making. And you try to keep those people who have the unique domain expertise that I can't replicate after, right? They're just, I can't find another of that. You keep them. And what you'll find, here's the positive side. So this is going to be if you've never done this before, it's one of the hardest things you can do, because you're going to feel like you're turning your back on people that were good to you. it's easier if you move your mind to you're protecting people that you could save. Because you can't save everyone. If you're cutting people, it means that you can't save the whole company. That's just what it means. So you're saving the ones you can, not that you're turning your back on the ones you can't. That's a big mental shift in a lot of entrepreneurs' minds. And I'm always talking about entrepreneurial psychology. I'm an entrepreneur in resident at INSEAD, and all these young guys are coming to me, and I feel like a psychologist, because a lot of this really is psychology, right? So that's a big move. You're saving the ones you can. The second thing is, when you get through this, you're going to be surprised how much stronger your company is than you thought it would be. Because what will end up happening is you will have eliminated a lot of fat that was holding you back in ways you didn't know. In our company, we talk a lot about this idea of holograms. So you're going down the court, you're playing basketball, and you throw a ball to somebody, and then they just magically don't catch it, and it goes out of bounds. And you can't figure out how they missed it. Then the second time you throw it, same thing happens. Well, what you've got there is actually a hologram. They look like a human, they act like a human, but they can't move the business forward. They can just act like they're in that role. And the sooner the holograms get off the court, the better the team plays. I'd rather play 3-on-5 in basketball if I knew I had 3 players. And so the reality is when you're through it, you will be better off for it in ways you couldn't imagine at the time. But don't do it in phases. That's not humane. It'll destroy the psychology and culture of your company. Make the cut if you're going to do it, and create the runway. And then the people that are there, grab them like a band of brothers or sisters or people and say, we're here to make this happen. This is our vision. This is our purpose. You know, people talk about vision statements and companies and cultures and values. It's in a crisis that you understand who the quality, the content of the character of your leaders. And this is why I keep telling all the founders, go back to your core principles, get clear, go work out, burn the cortisol out of your system, get your chi clear. You know why you started the business. Stay true to that vision, true to that principle. VCs are a dime a dozen. I mean, I don't mean to be rude, but they're a dime a dozen. They'll come back when the market's right, when they see momentum, or they won't. But the entrepreneur can't base their company on that. It's got to be based on a purpose and a vision, and that's just what it's got to be. And they can't lose that. They lose that, they lose the company.
Got it. Yeah, that's good advice, Cole. Dave, another question from the Q&A. You know, there are startups that are in the middle of much longer R&D cycles. How do they attempt surfing this current tide? Because they're going to have to make some immediate adjustments, and that's what today's panel is about. But how are they supposed to do it with longer R&D cycles?
You know, it's a hard question to answer without, you know, thinking about a company and specifics. But my hope is that the issues that we're facing now, you know, are issues that will be dealt with over the next couple of months. And so we have a company in our portfolio that is building a platform. Their revenue has literally gone to zero. And so what we're doing is we're ensuring that we can maintain the OpEx, and we can maintain the tech team where we can build that platform and continue to hit our product milestones, even though the revenue is currently at zero. And so there's other ways you can do that. You can think creatively about short-term revenue. Ashish, I think, made some great comments about cash. You know, I've always said, you know, founders tend to really understand a P&L, but not necessarily a balance sheet or statement of cash flows. But I think cash never lies. You know, you can adjust the P&L and you can, you know, have things come in or come out at different levels, but cash, you can't, never lies. And so I agree with him wholeheartedly that you should run the business on a cash flows. And if there are creative ways where you can, you know, pre-sell or get some money in the door that can help finance, then I think you can go down all those avenues. But I would, you know, to Cole's point, you have to think about what's the core, you know, why are you here? And if your core business involves a long-term R&D cycle, then I think you have to figure out ways you can continue to fund that.
Yeah, got it.
You could potentially, Hari, you could potentially, I mean, just some very, very grassroots ideas, right? Again, this is survival, not the ideal thing to do. But try to work with your anchor customers and get some fees off them, right? Some of the R&D can also generate fee-based revenues. And if you're a really small team and with smart people, you'll figure out a way to earn your living while building your product.
So that's a good point. I think, you can't time everything. So there are founders who need to connect with investors right now, right? I mean, all of you have given some advice around, how VCs are viewing this, and Ashish made a great point of VCs and, them being accountable to their LPs as well. But are there specific strategies that startups can adopt when pitching or closing deals over these virtual meetings? I think today's panel has been fun, but there's not a deal to be had right now. I guess the question to any one of you, honestly, but any tips on how entrepreneurs should think about this if they are in that mode and have to pitch or try and close a deal over a virtual meeting?
So if I may jump on that for a second.
Go for it.
It's starting a company that does anything that matters is statistically very unlikely. Like, you have to understand the nature of the challenge that you took on when you took it on, right? The core asset that the entrepreneur has is that they've put so much time and energy and blood and sweat and tears into creating a vision of the way the world should be and why the world would be much better because of that. If not for me, this wouldn't happen. And look at how amazing this thing is, right? So, remember the last cycle, Elon Musk just about went over the falls, right? And he did it in Tesla and he did it in SpaceX. But he was able to paint a vision, he was able to believe, and he was able to run through walls if he had to make it happen. So what you can't do is get caught up in, oh, poor me, this is a hard time. That's the time doing you. You got to do the time. So if you have to call every single VC in the entire world to get her deal done, then you do that. Walt Disney was turned down 300 times before he got his round done, right? 300 times. I don't know. There's almost no entrepreneur that I know that's actually failed 300 times in a round. Larry and Sergey failed almost 100 times. So, and that's in a good market. You can't allow fear into your psychology. You're not that guy. If you want to be a risk-adjusted guy that's going out there and trying to kind of hedge their bets, then you're not an entrepreneur. And that's okay. I'm not against it. I've done a lot of work in hedge funds and venture funds, and I've done that. I understand that thought process. But we're heavyweight boxers. That's what it means to be the CEO and founder of an entrepreneurial company. So you can't go into the match thinking you're going to lose, right? You need to cut to 12 months, full stop. Doesn't matter how much it hurts, full stop. And then you need to get out there and learn how to punch harder to hit the way you need to hit. But you don't get to admit loss. You don't get oh, well, it was hard and I quit because. Like, that thought, when it creeps into your head, will do more to destroy you as an entrepreneur than anything else. Right? I can't be clear enough about that, because if they go down that road, well, are there any tips and tricks? Yeah, call everybody. Tell them why you're amazing. Do not hang up. Do not let them hang up. Push again and again and again and again until you win. I mean, it doesn't change. I mean, I don't know how to be more passionate about that, but you got to go down that road. There is no book. Oh yeah, here are the 5 tricks to do in a global pandemic in Singapore. That shit doesn't exist. Right?
I love the passion, Cole. Love it. I'm going to ask one. I'm very aware of time, and I'm going to try and keep us to it. So I'm going to ask one final question, and each of you, I'd love if you could give your perspective on it. There are other questions in the Q&A, and if you feel so inclined, please do jump in there and answer those questions. But this will be the final question that'll be answered live. It is from the Q&A section. And I thought it's a good one to end on, a little bit of positivity. As we exit a crisis, we hear about things we should have done to better position our business in the crisis. What seeds can we plant now?
So 2 big things for me, Hari. Listen closely to how your customer's life is changing and adapt to it. And second, this is a great time to recruit. If you have the resources, you will get fantastic resources, and it's a time to build a team which really can win once you're out of it.
Do you want me to go next? My answer is actually a lot with what Cole originally started in on. I think now is a great time to get your mental health together. I think most founders, just have very limited time for themselves, for kind of free thought, to sleep, to exercise, to spend time with family. I think now, the demand side is shut down, the supply side is shut down. You should try and be as productive as you can, but I think there's time that you can afford yourself now, unlike any other time over since you've been running your business, to actually spend some time with family, to get a good night's sleep, to read a book. And so I agree wholeheartedly with Cole that I think mental health would be a big focus, I think, for me to advise founders at this point.
My 2 cents is in volatile situations, it's not about the number of decisions you make, it's about the quality of the few decisions that you make. There'll be 2 or 3 decisions in a volatile market that'll make your company. So now is the time to get clear and make a few good decisions. It's not about making 100, it's making 2 or 3 really good ones. And if you do that, you'll come out of this and you'll be much stronger than you came into it. And you'll have a big scar on your back that you can reflect on and laugh about much after it's healed, a long time from now.
I love that, Cole. I talk a lot about scar tissue in my company, but it's not about that. I think I just want to wrap at this point. And, I hope everyone who paid attention and attended this session, we had over 100 at one point, really felt as inspired by the energy that 3 of you gave. I think, really what I call real advice coming through from folks who are investing or running companies, who understand what it feels like to go through here. Advice from everywhere, from taking care of your mental health and your chi, to some of those harder decisions that people may have to take in these situations. How to think about the future, how to get ready for situations which can be challenging, hopefully not as challenging as this one in the future, but you will have other challenges which come up as well. I hope you will join me in thanking our panelists for sharing their wisdom. I definitely feel a whole lot more informed. I hope you do as well, about steps that you and your companies can consider taking. By the way, I feel we can all learn from each other in such a challenging period. So I think we've heard from 3 experts today. I think the endeavor definitely from these networks is at times like this to look to the future at a time when we are away from this, when we're able to meet, when we're able to actually conduct business more freely, to actually be able to look forward to that. And I think that's why I was so excited to participate in this huddle. But I'll end by quoting Dave. Is one of the first things he said. He said the number 1 rule of business is staying in business. I think that was good advice. So thank you for that, Dave. Thank you, Cole. Thank you, Ashish. Really, really useful. And I'll hand off to Sidhi, who's our exec director for TiE, to say a few words to wrap up this huddle.
Great. Thank you, Hari. This was an engaging session. Thank you, all our panelists, Ashish, Cole, David, and Hari, to kickstart our huddle sessions. Folks, thank you for joining. We've got 103 folks entering. This is amazing. Please stay tuned. This will happen every Wednesday at 5 p.m. The next session is on supply chain dynamics. And we have Ankiti Bose, founder of Zilingo, and Suresh Shankar, founder of Crayon Data, talking about it. So stay tuned. Also, like Dave and Cole mentioned, mental health is really important. So we've started a mental health series. The first one kicks off on Tuesday, 14th of April at 4:30. Where we are going to talk about how do you combat anxiety and how do you create your own personal continuity plan moving forward. So thank you so much and stay tuned. See you next week on Wednesday. Bye.